Today is the part 1 of our 2-part series. So the next session will happen in 2 weeks from now. Welcome, Liana. I see you've also joined us. Then, so today we will be focusing on how to safeguard your business from the crediting. And like I mentioned already, please make use of the Q&A functionality. We want to engage with you. There's a lot of you who are very active in the Q&A, and we love it. We want to answer your questions. Then also we are fortunate enough to have 2 guest speakers with us today who are specialists in their fields. They've both turned on their cameras now. Our first speaker will be HP Turin, who is one of PPS's technical specialists. He is with a focus on financial planning as well as business assurance. HP holds a qualification in economics and also econometrics. I almost got that wrong. And HP also has an experience of 6 years within the industry, in the financial industry. Before then, he worked as a group accountant. But for the last 6 years, he's worked with high net worth individuals, both in the local as well as offshore market. And he also assists individuals in doing holistic financial planning with a focus in investments, estate planning, as well as retirement. Then our second speaker is Queen. And Queen has an experience in the financial industry of 15 years. And before then, she was employed with Standard Bank for the last 8 years. And Queen has qualifications in financial planning, as well as she has a national certificate in wealth management. And she also has extensive experience in investments, life assurance, medical aid, as well as short-term insurance. And she's more than capable to assist any one of our members on any one of the financial planning solutions that PPS offers. So in saying that, that is a complete mouthful. So HP, I'm going to hand over to you to start us off with this session for today.
Thanks, Yamari, and welcome everyone on this cold Wednesday morning, or afternoon, actually. Today we'll have a discussion regarding safeguarding your business, especially from the creditors thing, more pertaining to all the various types of loans and debts that a company might have. Just to start off with, there are quite a few wealth-altering events that can affect the business owner as well as the company itself, as well as other stakeholders within the company, as well as the staff. And a lot of these are actually, you can plan for them. For example, when you're going through divorce, or when you're immigrating, or sequestration happens, etc. Usually that involves the whole company, and people are aware of it and people can plan for it. But there are some events that is a bit more of a, I can almost say, a surprise, and it should be planned for as much as possible. And the 3 events that I would like to discuss today is death, disability, and critical illness, and how important these things can be, and how actually this can affect your company's well-being if not planned for properly. Now, with death, we all know that that's a certainty for all of us that we will pass away someday. So that's almost like a guarantee that that would happen somewhere down the road. But then disability and critical illness is something that might happen or might not happen. But the problem with that is, should that happen? Because a lot of people say, yeah, it will never happen to me. And then somebody close to them gets into an incident or something, and it actually becomes a lot more real to you. And unfortunately, sometimes what they would say is hindsight is an exact science. Then it's a bit too late to start planning for those type of processes. And it's very important to have a discussion with your financial planner regarding these events, not only in your personal capacity, but also regarding your business, and as this can affect your own estate, as well as the remaining owners in the company, as well as creditors involved within your company, as well as the remaining staff. So it's very important to really look closely at these and plan appropriately, because if you plan properly, they always say failing to plan is planning to fail. But also when you're planning to succeed and to provide for this, it might not be such a big issue should something happen to this, as everything can be looked after. But Queen, from the looks of this, there are obviously quite a few role players in business planning, and it can sometimes become overwhelming as there are so many elements and so many things to look after. Can you perhaps share with us how you usually go about when you do a business planning conversation with one of your potential or existing clients?
Yes, definitely. Thank you, HP. You're right. Business planning can be quite overwhelming, as so many different elements to business planning. So at PPS, we try to remove all the clutter and uncertainty our business owners feel by accompanying them with a simplified business assurance journey consisting of these 4 steps. So if we can have a look, the first step entails protecting the business as well as your personal estate against third-party creditors. And if we go through our business journey, the second step will look at the implications of extending loans to your business using your own capital. We'll have also a look at how would we basically ensure that your business will be able to actually repay those loans. And if we actually look at also our third step as well, which is actually quite important because we'll focus more on how the business impact losing of your most valuable player. So this can be an employee with a specific skill set or network. So it basically is that person in your organization that contributes for something specific and valuable that is crucial to the business profitability. So we'll have a look at that as to you as the business owner, what you can do to prepare for such unfortunate events where you actually lose your most valuable player. So if we actually have a look, so far we've looked at what can or should do to ensure that your business will have necessary capital available to settle all of these financial obligations. So we have a look at what business can do to provide for those potential loss of a key employee. But what about you as a business owner and the role you play with the business? What will happen should, say, maybe, for example, you pass away tomorrow, because we all know that death is certain, but we actually don't know as to when it will actually happen. And who will actually step in your shoes as a shareholder tomorrow and look after your business if you're no longer able to actually do so yourself? So during the fourth step, we deal with your business succession plan and how you can finance such arrangements. So the business assurance journey is thus aimed to providing you as a business owner with certainty that your business will necessarily financial liquidity to cover all those above mentioned areas. So which instrument in any succession planning and financial planning process. So to kick off today, we're gonna have some introspection and where we basically certainly are. So if we have actually a look, you will note that this question tests various scenarios that will make them so great, because then you think, what will happen practically should you pass away tomorrow? The most important questions that you should actually ask yourself is that, will the business have sufficient funds to pay all those creditors upon a trigger event? Can the business afford to repay the loan I gave it on my death? What will happen if one of your star employees, your most valuable players, who has a unique skill set and contacts, dies tomorrow? If my partner becomes disabled or dies, will I have the necessary cash available to buy his interest or in our business? Will there be sufficient funds left for my family to meet their income needs? So I want to encourage our audience today to start having these conversations with their co-shareholders and even their accountant next time they go through their business financials to determine basically business positions in light of this risk at each and every step as it impacts on various stakeholders, which we basically touched on earlier.
I can't agree with you more, Queen. I think they can even use these questions as a guideline when they're having this discussion to actually see where they are. Yes,
definitely, HP. These questions can definitely be used to facilitate the conversations with the co-shareholders, because now in today's session, we not only going to unpack the first and the second step of this journey, which means that we are only going to look at what you as a business owner can do to actually ensure that the business will have necessary capital available to settle all its liabilities that may be triggered as a result of your death. So HP, can you maybe perhaps tell us what are the factors give rise to these business needs?
Thanks, Queen. Yes, let's start at the beginning. Where do these potential problems arise? Now, what happens is we have quite a various amount of business entities where whereby people conduct their business. To name a few, you'll have a sole proprietorship, you'll have a closed corporation, partnerships, and private and public companies. And people enter into these various different vehicles for specific reasons. So there's no cookie cutter approach to say this is the correct business entity for all. It all depends on the specific need and the specific purpose of the business and how you want to use this business entity. But during today's session, we're going to talk mostly regarding the company structure, as this would also pertain to mostly to closed corporations as well as sole proprietors. And most of you business owners would be familiar with the company structure. If we have some people in the medical profession, we might have a few that are in partnerships, but the bulk would definitely be within a company. Maybe we can go to the Q&A functionality, and if people can just comment there, whether they're in a CC or partnership or a PTY limited, etc. It would be interesting to see the various diverse business owners that we have on our session today. But the main thing that I want to discuss actually today, whilst people are starting to comment on the Q&A function, is two features of a company that I actually want to spend some time on today, pertaining to specifically companies, but most of these would also spill over to a lot of the other business entities as well. And the first is the legal personality of a company. A company becomes actually a separate legal entity as soon as it's registered with a register of companies and the certificate of incorporation has been issued by the registrar. What that basically means is that this is a separate legal person, if I can call it that, which can have his own assets, have his own liabilities, can borrow money, and can also make a profit, and he would also be a separate taxpayer at the end of the day. So for all intents and purposes, this would be a different person than the individual shareholders that actually owns the company. So the two points that I want to have regarding the benefit of being a separate legal entity is liability to creditors. First of all, this is a debt that the company takes out in its own name, if I can call it that. So this is not the shareholder's debt, but actually the company's debt. So the liability of the shareholder is only limited to what he contributed or what he undertook to contribute to the company. But the major thing is there is what we'll discuss a bit later on is when you've signed surety for this debt, or when you are the person that actually borrowed the money to the company. We'll have a discussion on those two topics further down in the session today. And then perpetual succession. This basically means that this company continues to exist even if something happens to one of the shareholders. As this company is now its own entity, it's not dependent on the survival of a shareholder that like you would have with a sole proprietorship, for example. If the sole proprietor passes away, the sole proprietorship ends as well. With a company, that's not the case. The company would continue even though one of the shareholders has passed away or has moved on or immigrated or whatever the case might be. So,
sorry.
Yes.
Sorry to cut you there.
No. Please.
I just want to mention to you that Narisha has commented in the chat functionality to say that, hi, I'm an audiologist and my company is a PTY limited. So if you maybe want to comment on that.
That's brilliant. It's actually quite interesting. A lot of people in the medical professions actually have partnership agreements and not PTY limited. So it's interesting to see somebody in that line of profession that actually has a PTY limited. And there are quite a few benefits, as I've mentioned now, regarding having a company, a private company, being a separate taxpayer, etc. And there are quite a few benefits to be a registered company. Even for the medical professions. So thanks for that comment. It's interesting to see that even our medical professions sometimes have a private company rather than a partnership. Now, the main thing with a company is usually when we start off with a company is we need to have funding to start off with our project, whether it is to buy equipment, whether it is to buy vehicles, whether it is to get a storefront going, to employ people. There are various different things. And when you start a company, usually there aren't any fundings. There are the potential for future profits, but when we start off, there then there aren't any funding. So we need to source this elsewhere. So the first place usually is with a personal loan, where one or more of the shareholders would actually provide capital into the company so that the company can start operating. And other than that, we can have a third party funding it, usually through a bank or other arrangements. And usually when you want to take out a bank loan, a lot of the banks would require you to show a proof that you would actually be able to pay back the money. And therefore, a lot of times the shareholders actually need to sign a surety to guarantee. If I can compare that to something that everyone would understand, is usually when somebody finished with his degree and he starts working, he does not necessarily have a salary yet to buy a vehicle to go to work and back. And a lot of times a parent would sign surety so that his son or his daughter can actually buy this vehicle. And then, although he's paying it off himself, his dad or his parent needs to sign the surety to stand in the gap should he fail to make the payment, that the bank can actually recover the funds from the father. It's the same with when you sign surety within the company, is you actually stand in the gap for the company, and thereby you will be liable for the payments of that debt. So Queen, if we can just look at external funding a bit more in depth, if you can perhaps just go through a few examples of what external funding would look like.
Yes, thank you, HP. So external funding is normally part of the business and its capital structure, and most business owners will be forced to sign surety for a debt of the business at some stage by either a bank or a supplier. So conventional lending, whether it's in a form of an overdraft facility or a term loan or asset finance through a financial institution such as a bank, is available to businesses that can prove that they are strong in their financial track record. This is a great source of financing as it allows for extended repayments over time with fixed monthly payments. But the bank, however, will require owners to prove their revenue resources, profit levels, or even detailed plans before approving the loan, and may even require, as we mentioned earlier, the owner to stand surety for the funding acquired to provide, for instance, where business is not actually able to settle the debt when it's actually called up for. So HP, maybe we can have a look at what the situation basically typically entails.
Yes, so to delve a bit deeper into signing surety, is usually what happens is the company needs funding from a bank, and the bank needs proof that funding would be settled or would be paid back. And so the shareholder would sign the surety, and the bank would look at the financials of the individual as well, his financial capacity to approve this loan, and on those terms actually borrow the money to the company. So the problem there is, if the company then fails to settle the debt timelessly, the bank can come to the shareholder directly to settle these amounts. Further to that, should this shareholder pass away or not be a shareholder of the company anymore, they can actually then decide to withdraw the whole financing offer, and thereby looking to settle the debt completely. And a lot of people ask, but why? And because the security profile has changed, because they have looked at this specific shareholder and his finances, and according to that, that's the reason why they have provided the finance. So if he's not a player in the game anymore, that structure changed, and they are the banks are then exposed to a risk that they are not comfortable with. So then they can actually come to the company themselves or to the shareholder individually to recover those losses. And a failure to have an alternative arrangement with a creditor can have a massive effect when it comes to your estate as well, because now the bank can actually come to your personal estate for this funding, and that can cause a massive time delay with the winding up of the estate, as well as a much lower estate value at the end of the day, should they need to recover that from the individual itself, because now they've recovered it from the shareholder. Now the shareholder's estate has a claim back to the company, and the company didn't have the money in the first place to settle that debt. So how would they then settle the debt to the estate of the deceased shareholder? So that causes a massive problem when you're starting to wind up estate. So the consequences of signing suretyship, as you remembered earlier, I discussed the separate legal entity, a company being a separate legal entity. Well, when you sign suretyship, you become joint and severable liable. And what that basically means is you can also be held liable for the debts of the company as you have signed the suretyship. And it all depends on the various different elements that I'll discuss now on how you are exposed actually. So we get unlimited versus limited suretyship. Now, the difference between that is limited suretyship means that you're only liable for a specific debt that, or a specific amount that was occurred at a specific period of time. And that's not usually the case when it comes to money that was borrowed from the bank. Usually they work with unlimited suretyship. And what that basically means is you've signed suretyship, for example, for finance for your vehicle fleet, etc. But you also have an overdraft account, etc., etc. So if you have unlimited suretyship, it's not only pertaining to that specific deal that you've borrowed the money for, but all the debts with the bank is actually included in that. So that suretyship would continue. So even if you've paid back the vehicle finance, if you still have that surety in place, the bank can actually then recover any of the other debts owed to them from you as a surety member. And therefore, it's very important to have what we call a contingent liability agreement in place, because should you have settled the debt, it's important to have a written confirmation that the suretyship has ended. And that's the most important thing to remember, is that you have to have that agreement in writing, as that can protect you quite a lot, especially when you're when we look at your estate at the end of the day. When you're not here anymore, there's nothing that you can do about it. Another thing is the benefit of excussion. That's also something that you usually renounce when you sign suretyship. What excussion basically means is that what excussion means is the bank would first go to the company to settle the debt, and if they're not successful, then they can recover it from you personally by pursuing your personal estate. But now you've renounced that benefit, so they can actually come directly to your personal estate if they see that's the point of least resistance, or if that's the specific easiest route for them to recover their debts. Because if you look from the bank side, their main objective is to make sure that they're not exposed to unnecessary risk, and they want to settle that risk and that debt as timely as possible. Another thing is that the benefit of division. You also usually renounce the benefit of division. What that basically means is if you are more than one shareholder that signs suretyship, you would perceive it as the debt has been divided between the various shareholders. But if you renounce your benefit of division, they can actually come for the full amount to your specific estate, not only to the portion that you thought you were exposed to. So in effect, what happens is you have pierced the corporate veil. So the previous legal entity that I've mentioned is now not completely separate from your personal estate, because now you become equally exposed to this debt. And maybe I can ask the Q&A functionality again, who of you perhaps have signed suretyship within your company structure when you've borrowed money from the banks or from other suppliers? Who have signed suretyship, and are you actually comfortable with that? Perhaps if you can comment there with surety, and then as well with a thumbs up or a thumbs down if you've actually, if you know if you've got an agreement in place to protect you from this.
HP, I will keep an eye on the chat functionality, and I will read it out to you as soon as people post.
As we continue, I want to re-emphasize the importance of that contract. A lot of people would tell me, it's fine, I've got a contingent liability cover in place, so should something happen to me, should I become disabled, should I pass away, I've got this policy that would pay out. And that's usually how the structure works, is when we sign suretyship for this loan, the bank would in essence actually require proof of this life policy being in place for them to know that should something happen to the shareholder, that there is funding available to settle this debt. But the main thing there is the agreement. The bank would not necessarily be so concerned about the agreement. They're only concerned that their debt would be settled. But for you as a shareholder, as well as all the other shareholders, it's very important to have this signed agreement to support this life cover policy. As this is, as I mentioned earlier, it's very important, as this would stop the agreement, that would stop the surety. Should something happen to you, then the relationship ends between you and the company when it pertains to the suretyship. So it's important to have the agreement in place as well, not only the cover. And the important thing is to actually have a discussion with your financial advisor to make sure that the agreement actually speaks to the session on the policy, and to make sure that the policy and the session amount as well as the agreement all speaks about the same amount of values and the same creditors. Because a lot of time people have signed suretyship and they're not 100% sure how much they are exposed and how they are exposed, etc. So it's important to do a full business needs analysis, and therefore it's important to do this, and that's where specialist support services comes in to play. Is we are actually a part of PPS, and we assist our members with doing that specific analysis for you to say, this is the sureties that you've signed for, this is what you're exposed to, and let's do the agreement to make sure that it speaks exactly to that. So that's how we can make sure that it's an end-to-end solution for you, and not only covering the basis of the policy, but also the agreement. And to talk a bit more about how the policy should be structured, Queen, if you can perhaps run us through of how this specific contingent liability cover should be structured.
No, definitely. So if we have a look at how to basically structure that solution. So we will have the policyholder. This basically is the owner of the policy. In this case, it will be the business. And on the life insured, this will be the person of whose life of the policy is actually taken out from. And in this case, it will be the person who stood surety for the business. And if we look at the premium payer, this will be the person who will actually be paying those policy premiums. And in this case, it will actually be the business as well. And on the beneficiary, one question is that who actually should receive the policy proceeds? So in this case, it will be the business, as the business is the one that actually needs the capital to actually settle the loan. So the policy proceeds then have to be paid out into the hands of actually the business. So in most of these cases, the bank will require the life policy to actually be ceded to them as a security for the loan, and it will actually be perfectly fine. But what I want to also highlight here is that it's the cases where the life policy is actually not ceded. This is such a case where contingent liability agreement, as you've actually mentioned earlier, that is plays a crucial role. So the contingent liability agreement will ensure that the business will use the policy proceeds towards settling of the outstanding loan. So I think there you can actually take us through HP of what are the tax consequences.
So there are quite a few things to consider when we look at a contingent liability agreement, and two other things that we should look at is income tax as well as estate duty. Income tax, a lot of times people would come to me and say, well, this is a policy that's getting, the premiums are paid by the company itself, so I can use this as a deduction for my income tax. But unfortunately, as the purpose of this policy is to repay a loan, which are capital in nature, the policy therefore does not comply with Section 11W2, and that the purpose must be to protect the company against the loss of income, where this is not the case, and therefore the premiums aren't deducted. But remember, if you do not deduct the premiums, the proceeds will not be taxable. So even with, for example, key man insurance, where you can actually deduct the premiums, if you deduct the premiums, you must remember that the proceeds would then be taxable. So make sure that you make the correct calculation, get a specialist to do the business needs analysis to show you the effect of tax on the amount of cover that you actually need. Another thing that also affects that is estate duty. As this is regarded as being utilized for the benefit of the deceased's dependents and doesn't comply with the requirements of Section 33A of the Estate Duty Act, which deals with policy exemptions, this policy would actually be estate dutiable. So it's very, very important to make sure that you make the necessary adjustments to cover sufficiently for the estate duty as well. To give you an example, if you have contingent liability exposure of about 1 million rand, you actually need 1.25 million rand. Once the 20% estate duty is deducted, you'll have a net amount of 1 million rand, which would be sufficient to cover that debt. And if you did not provide for that, then the company needs to pay out of their own pockets for that shortfall, or else the company would still be 20% short, and the bank would then recover either from the company or once again from the deceased estate that 20% shortfall on the debt that arose. So it's very important to make sure that you have the discussion with your specialist to make sure that all the bases are covered. I know it's quite a mouthful, but that's where the planning process comes in, and to make sure that you can sleep at night comfortably knowing that everything is looked after properly, and I know exactly what I'm in for, and I know exactly what policy is for what, and what agreement speaks to what exposure that I've got. So the benefits of a properly structured policy is quite a lot. And Queen, I think if you can perhaps discuss this with us to show us all the various benefits that we've got pertaining to the various shareholders. Okay, thank you, HP. I think here we're looking at basically three aspects of a structured solution. So we'll be looking at the business, because the business can secure that credit facility to actually finance its expansion, and the business will be able to meet its obligations in an event of death, disability, or critical illness. In this case, your critical illness will actually be your dread disease of the surety, and it will avoid potential insolvency. And as a business owner, the surety as well doesn't have the responsibility of actually paying the contributions. So the surety knows that the business will have sufficient funds to meet the obligations for which he has stood surety for. And the family as well, which is one most important aspect, is that the surety's estate will not have to bear with the liability of these obligations, and his dependents or heirs will not suffer any financial hardships because of him having to sign surety during this lifetime. So PPS, that's where we actually come in with HP, that we offer different types of product solutions, which is your life cover, which can actually be accelerated with your disability and critical illness as well. And we also offer a range of different premium patterns, whereby if you as a business owner can actually decide to say, okay, you know what, I want to have the premium remain the same or increase it with my age, and it will also be dependent on your affordability. So maybe if HP, you can actually work us through how you will be able to actually repay those loans. Okay, so further to a third-party funding, lots of times when we start off with a company, the shareholders themselves would provide capital for the initial startup of the company. And even furthermore, as the company progresses, a lot of times they would, what we call retained earnings, they would not necessarily pay out dividends to the shareholders, but rather keep that within the company to make sure that the cash flow of the company is looked after. And they might even provide additional capital for future projects as the company grows. The fleet might need increasing, all various type of things. And sometimes the shareholders themselves have the funding available to provide the capital for these type of exercises to be done within the company. And a lot of people, and myself included, prefer to use my own money when I work with business rather than borrowing. And therefore, this is a silent killer within all the balance sheets. One place that you should look for is on the balance sheets under non-current liabilities. You'll see a shareholders' loans, and there you can actually see the amount of money that the company owes the shareholders. Now, a lot of times people would tell me, well, that's just not a big problem because it's my company, so why would I be concerned about the company paying back my own money? It's my company, it's my money, so why? The problem is when should something happen to you, especially when you're more than one shareholder, should something happen to one of the shareholders, the company should pay back that loan. And a massive question to ask is, does the company actually have the cash flow to pay back that loan? They actually had that capital injection from the shareholder because they did not have the money. So most cases would say that that's not possible for the company to do. So the memo of incorporation of the company would actually provide guidance on how it should be dealt with. Should somebody die or sell his shares, etc., what would happen to that shareholder's loans? And therefore, it's important to also make sure that you have that memo of incorporation with you when you have this discussion with your financial planner to make sure that the correct solution is looked for. And to elaborate a bit more on that is there are many ways that we can actually solution this specific need. And the first is by the business repaying that loan. So what happens in that scenario is the company would take out a life policy on each individual shareholder that borrowed money to the company, and that would be settled should the shareholder leave the company or should pass away, etc. But when you settle that loan account, obviously the net asset value of the company would therefore increase. With that policy, the premiums would be payable by the business because they would receive that proceeds to settle that loan account. Tax-wise, this would also be subject to estate duty, and it might have an income tax and capital gains tax implication, all depending on what the shareholders, if it's in his personal capacity or whether it is held in a trust, etc., etc. So there might be tax implications that needs to be discussed with your advisor as well. The other scenario that we've got is where a partner buys the loan. Usually what happens in this scenario is when we have more than one shareholder, I'll have a buy and sell agreement to buy out the deceased shareholder's shares. And then we include that loan account. So no, I won't only buy the shares of that individual, I would also take over his loan account. So now the company still owes this debt, but it doesn't owe it to the deceased party anymore, but it would owe that funding to the rest of the shareholders within the company. So therefore, there's no impact on the net asset value of the business because the loan account was not settled, it was just transferred to other shareholders. And therefore, this is not a separate agreement or a separate policy that's taken out. It would be included in my buy and sell, and therefore the premiums are payable by the various shareholders in the buy and sell agreement. Buy and sell agreements, we will have that discussion in our next session. You will be keep posted regarding this. You'll also receive an emailer after this webinar whereby we will discuss with you the next session, which would include this buy and sell agreement. Tax-wise, regarding this, is there wouldn't be any income tax implications as there is no separate policy owned by the company, and the proceeds might be exempt from estate duty depending on the shareholding, whether it is in your personal capacity, whether it is in a trust, whether it's from a various different other business entities that might hold the shareholding on your behalf. So that's also important to make sure that you structure that properly. The consequences, if you do not have this in place, is that loan account needs to be settled, and that can have a massive bearing once again on your personal estate. And therefore, if we look at on the first side, when the company actually has a separate policy to actually repay back the loan to the shareholder, it needs to be structured accordingly. And Queen, if you can perhaps run through the structure of this specific policy for us.
Thank you, HP. So we're going to have a look at as to how do you structure such a solution. So the policyholder, this basically means that the owner of the policy, in this case, it will actually be the business. And the life insured, this is the person whose life on the policy is actually taken out. And in this case, it will be the person who extended the loan for the business, which is the creditor. And the premium payer, this is basically the person who will pay the premium or the policy premium. And in this case, it will also be the business. And I guess, again, the most important question to actually ask of the beneficiary is that who should actually receive the policy proceeds. So in this case, it will be the business, as the business needs that capital to actually settle the loan. So the policy proceed then have to pay into the hands of the business so that they can have necessary capital to pay the deceased estate as a settlement of actually the loan account. So I think HP there, you can also take us through as to what would be the benefit of a properly structured solution.
Thanks, Queen. I think that the most important thing before I go through this slide is, I think, peace of mind with all the various needs that we've just discussed is, as a business owner, there are so many stresses, and we look at things like COVID, for example, now, so many of our business entities are really taking strain, and there's so many things on their plate, stresses that they have, paying back debt, paying staff that's in lockdown, all those type of things. So there's so many stresses already onto a business owner, and now to actually add all of these other stresses of, well, I've got exposure regarding contingent liability, I've got other shareholders that has borrowed money to the company, all these various type of things that can actually cause sleepless nights. Well, if we've got the properly structured policy, all those stresses are taken away. And another further benefit of this is, if we go back to the slide now, is the cash injection to this business, because now remember, this debt has been settled. So there's a massive liability off the books. So your cash flow in effect is actually increased quite a lot, because there's not that a recurring interest that needs to be paid on these loan accounts, etc. So the financial standing of the company actually increased a lot, and a lot of times that's very important, as should one of the shareholders have passed away, it's actually one of the key players that's now missing from the company, and that might cause a financial strain on this company, and you do not want any additional strain of a loan account that needs to be paid, etc. So it might be a good idea to rather settle the loan account rather than transferring it to other shareholders. Specifically for that reason, is to actually increase the cash flow and reducing future financing costs and interest regarding these type of loan accounts. So it's very important to have a look at all these various factors before you decide to solution it by transferring it via buy and sell, or whether settling that specific loan account. And I know that this might have been quite a mouthful today, and I want to thank you for your time and your patience, especially with the cold weather that we're having. Hopefully you're all sat close to a heat or nice and cozy at home. And I want you guys to make use of the Q&A functionality now. And if there's any questions that you might have, you'll also see the contact email on your screen now, lifeplan@PPS. If you've got any further questions that might arise, please make use of this email address. You'll also have a follow-up email regarding this. Please be in discussion with us and have a conversation. If you've got any other questions now, we'll have a bit of a Q&A session. But from my side, thank you very much for this session and for your time. It's highly appreciated, and I look forward to our next session where we will discuss the second 2 steps regarding this financial planning process for your business. Thank you from my side.
HP and Queen, thank you so much for yet another insightful session from both of you guys. I have a question though for you, HP. I know you've been burning to answer a question this whole session. Can one do succession planning for sole proprietors?
Yes, a lot of people would say, okay, but I'm not a private company. I do not have any other shareholders. I'm a one-man show. What do I do now if I'm doing my planning for my personal estate, and I know my company is worth, for example, 5 million, and I'm not there anymore, and my dependents actually rely on that type of cover? Yes, we can actually help you as a sole proprietor, whether it is with contingent liability for funding from outside, or whether it's a succession of the companies you've just mentioned. The important thing to note there is to make sure that you have a proper succession plan in place. One thing that underwriting would look at is, okay, this is a one-man show. If he's not there anymore, there's no company. So how do we continue? So it's important to have a specific succession plan in place, a specific person that would take over the role as the primary shareholder of the sole proprietor, or for this one-man show, it's usually a PTY limited with only one shareholder. So it's important to make sure that you've got a proper succession plan in place in writing to make sure, should something happen to me, this is the way forward. So yes, we can actually solution you when you've got a one-man show. Maybe it's a good idea to ask how many of you are sole proprietors or people that's got a company with only one shareholder.
Okay, perfect. So while we wait for somebody to maybe comment in the chat box, HP, thank you for always thoroughly answering questions. I'm sure everybody is very thankful for that. Guys, maybe just to remind you as well, HP did mention this too, that if you want to reach out to PPS and more specifically to Queen and HP themselves, you can send an email to lifeplan@pps.co.za. You will also receive an email from PPS whereby you will find a link that you can access this recording again on YouTube if you would like to watch it again and re-listen to some of the insights that both Queen and HP shared with you today. Is there any other questions that you guys would like to post, or if you if there's any comments you would like to make, you are welcome to do so. We will give a few minutes if there is anybody who has comments or questions. Queen, is there maybe anything else? Oh, sorry, HP.
No, continue.
No, sorry, I just wanted to give Queen an opportunity if there's anything else you would like to add, or maybe mention to existing PPS members or possibly prospective PPS members.
Yes, definitely. I think, again, the one of the most important thing is that there would be agreements in place, as HP mentioned earlier, whereby they were done maybe 3 or 4 years ago. And it is very important that basically you actually do a review in your portfolio for your business assurance as much as we do reviews on a yearly basis for your personal side, so that we can actually do a thorough analysis, myself and HP on the same team, to basically make sure that there's that continuous evaluation of your financial needs analysis, and that, okay, you might find that there's an agreement, but when last basically did you review your business portfolio?
Okay.
Yes, just to add on to what Queen said now, it's very important. You should actually look at these agreements as the way that you would review your will and testament when it comes to your personal estate as well, is because this is basically a letter of wishes to say exactly what should happen with these specific policy benefits, etc., etc. So it's important to review them on an annual basis. And a lot of people are concerned by this. I don't know if I've got an agreement in place, but now to redraw an agreement or whatever can cost me quite a lot of money. Well, that's the benefit of being a PPS member, is we've got, I'm part of a team called Specialist Support Services, and we have an obligation-free consultation with you where I can sit with you and look exactly what you are exposed to, do a proper business needs analysis. We can even assist you with drawing up contracts if need be, if there's new things to be implemented, etc. We'll make sure that all the policies speak to the agreements, make sure that everything is in place, make sure that all estate duties and other taxes are looked after properly. So it's obligation free, and there's no cost to you involved to get us involved into this process. So make use of it. Get in touch with us. Let us sit around a table or with a virtual consultation, with a Teams meeting or via Zoom, etc. And we'll have that discussion with you and assist you through this process. If you can provide us, for example, you're not aware of all of these type of things, we can run through your financial statements with you and sit with you to say, look at the exposure that you've got regarding this. This is roughly the value of your company with the various valuation methods that we'll use, etc. And we'll have a full-on analysis to discuss everything with you. So it's important to make use of this opportunity as a PPS member or a potential PPS member. Make use of it and make sure that you can actually have a peaceful night's sleep at the end of the day, making sure that all these type of concerns are looked after properly.
Definitely. Thank you for mentioning that, HB. It seems to me that you can only win from reaching out and, having a good conversation with both you and Queen. And I see that we don't have any more questions or comments in our Q&A functionality. So yes, that will be us for today. Thank you once again, Queen and HB. Thank you so much for everybody that participated in the Q&A function. Please look out for the email that will be sent to you. And please also look out for the invite to join part 2 of this specific series. So that is all from our side. And thank you very much. And I hope that you guys all have a great day further. Thank you, HB and Queen.
Thank you.
Thank you, Mary.